Well, I hate to break it to you, but we might have all been brainwashed when it comes to investing. Most finance professionals try to drill in the idea to us that investing is really hard and we should leave it to the professionals. But that is far away from the truth. Yes, the market can be violent and volatile, but investing is not as hard as we think. If we stick to the essential, we can really create a sustainable and successful portfolio. In fact, we do not need to worry about changing interest rate, inflation rate, or tracking GDP every quarter. When we first started investing, we typically hardly think about creating a long-term portfolio. Instead, we get motivated by the hope of making a quick gain from one particular stock that we're introduced to. However, in the long run, that's not really the right way to think about our investment. Because ironically, picking the right stock to invest might not be as important as creating the right system for our portfolio. This might sound counterintuitive, but it is true. The greatest investor around all invest in different types of stocks in their portfolio. Yet, each of them have strong process and system of investing which they can duplicate over and over again. So the key for us is really to create that system as well, instead of really worrying what might be the right time or right stock to invest in. So here are 5 easy steps for us to get started in creating the right portfolio process. Number 1, understand your time frame. Investing is a wonderful way to grow and store our wealth. It should not be seen as a method to make a quick buck. The first step of creating the right system is really to know how much time you really have and what is your objective in investing and creating this portfolio. For example, are you investing to retire? Or are you saving up for your kids' education? Or maybe you're wanting to create a perpetual trust fund for your family. And if you're serious about building up the wealth for yourself and your family, I strongly encourage you to give this question a little bit of thought. Only by knowing what you need this wealth for, then you have a better understanding and motivation in creating the right portfolio. And it is important for us to know that the stock market is a great place to store our wealth in the long term. But in the short term, it can feel like a gambling den. And if we observe some of the richest people in the world, we can see that most of their wealth are still tied to stocks. And they rarely get rich by just trading the stocks. So if the richest people in the world are getting rich by just storing their wealth in stocks, shouldn't we be emulating them as well to create more wealth for ourselves? Number 2, understand your risk exposure. After knowing how long you can stay invested in the stock market, it should give you more confidence to stay invested for the long term. Say if you can invest for another 20 years, then the current market downturn should not really trouble you too much. Maybe it can also turn out to be a great opportunity for you right now. Next, you have to think about your current risk exposure before investing. This is the risk that you have in your life due to your job or your place of residence or maybe your other investment. For example, if both you and your spouse are working in, say, one of the local banks in Singapore, and you're getting share options for your compensation and also staying in the country, then your life becomes very dependent on the prospect of both the bank and the nation. So imagine if the prospect of the bank start to decline, you and your spouse will have the risk of losing your job while the shares price of the bank will start declining as well, just at the moment where you need it the most. So in this way, you can see that you are too exposed to the fortune of your employer. That means that what you should really be considering is adding more overseas stocks and away from the banking sector to diversify your wealth. Number 3, drawing up and building up your circle of competence. There are tens of thousands of stocks available for us to invest in. And for a diversified portfolio, typically we only need up to around 30 companies in our portfolio. So as a stock investor, we can invest anywhere around the world, but our capital is always the limiting factor. Regardless of whether you have $1,000 or 10 million to invest, you will run out of capital faster than you can run out of ideas to invest in. So starting with companies and maybe industry that you're familiar with can help you get started in your portfolio. For me, I like to go to simple to understand business like consumer staple companies like maybe Nestle or Procter & Gamble, or some of the good industry to get you started might also be consumer discretionary companies like LVMH or Diageo. The real estate investment trust might be also a good sector for you to get started in. And also, other stable industry like utility can be a good starting point. Or you can also build the foundation of your portfolio with ETF. If you're unsure of what kind of stocks you should be investing at the very beginning, you can consider using ETF as an alternative to create that base for your investment. ETF or exchange traded fund can be seen as their unit trusts that are traded as stocks on the stock market. This means that we can buy this fund directly from the stock market, similar to buying a stock. And the advantages of ETF over unit trusts are typically they tend to have much lower transactional fees, as we're just paying brokerage fee when we're buying them. And also they tend to have better liquidity, meaning that we can sell it anytime we want in the stock market. And they also tend to have lower management fee as well when compared to unit trusts. Right now, the US is home to some of the best and largest ETF in the world. So to get started in finding the right ETF for you, one of the good websites that I tend to use is etfdb.com. You can also check that out as well. And lastly, number 5, having an investment system. Now we should think about how to create that system for our portfolio. And for example, we can create a pyramid structure on what kind of stocks you want in your portfolio. Maybe using my own portfolio as an example, the foundation of my portfolio is made up of strong and stable companies. These are companies or ETF in stable industry like consumer staples or utility. They tend to have a long history of growth as well and tend to pay a dividend. This group generally make up maybe about 50% of my entire portfolio. Next, you can then choose to add stocks within maybe the growth sector or the asset value category. That will again take up maybe about 20 to 40% of your portfolio. And lastly, if you're interested, you can then add in some speculative stock at the tip of your portfolio. This might maybe just take up 10% of your portfolio. Speculative stock could be newly listed fast-growing companies or companies that are facing financial trouble but are turning around their situation. Typically, this is a company that either make it big or could crash and burn. So now, once we have all the basics down, we can repeat this process over and over again to build up our portfolio. We do not really need to create a diversified portfolio right from the start. If we are committed to investing for the long term, we can always slowly build up this portfolio over time. My own portfolio took about 5 years before I would deem it as well diversified. So you really need some time and patience in building up your ideal portfolio. So there you have it. What are some of the key lessons you learned in investing? Remember to share with us below. And if you've gotten value from the video, please give us a like and share it with a friend who you might think will benefit from it as well. And if you're planning to start your investing journey right now, you can always check out our Premium Club, where we provide you with a comprehensive stock report every single month. You can check it out by going to valueinvestasia.com and clicking on Value Invest Asia Premium Club to find out more. Anyway, as always, my name is Stanley. Till we meet again, invest safely.